Good afternoon, ladies and gentlemen, and welcome to the Munro Partners webinar. I'm Steve Fletcher and I'm your host for today. On behalf of the distribution team at GSFM and Munro Partners, thanks for joining us to hear the latest on the Munro Global Growth Fund. We appreciate how busy everyone is, so we're going to keep the formal part of the webinar to approximately 25 to 30 minutes. And that'll then be followed by, we'll follow on with your questions. And you can submit those questions at any time during the presentation in the Q&A box at the bottom of your screen. And any questions that we don't get to, we'll be sure to follow up after the session. Now, on the call with me today, I have Munro CIO, Nick Griffin. Welcome, Nick.
Thanks, Steve.
It's great to have you on the call. Thanks very much for joining us. Nick, as a way of keeping our clients updated, today's session, I'm going to ask you around about half a dozen questions, and these will cover all the key aspects of the fund. And then, as I said, we can go to the audience Q&A after that. So let's get straight into it. And my first question, Nick, is, before we ask you how you're seeing the world and what's going on within your portfolio right now, Munro have recently bolstered the investment team with 2 new hires. Would you like to take the listeners on the call through these exciting additions to the team?
Yeah, thanks, Steve. Thanks for the question, and thanks very much for dialing in and your interest in our funds today. So as Steve mentioned, we have, Munro Partners is set up to be your global growth manager. Our goal really is to build, to invest in the journey of the growth landscape and to build this capability here in Melbourne where we're based, where we can basically take really long-term views of the world and invest in great businesses. That ultimately drives the double-digit returns within our funds. The other thing you hear me talk about quite a lot at Munro is that we are a partnership. And so it's important to stress, that we own and control 75% of our firms, 75% of the firm, and we give equity to our staff. We give it to them for free to bring them into the profit share of the business. And what that means is they earn profit share while they're here, and when they leave, they give it back for nothing as well. And so that partnership structure has allowed us to build from, quite frankly, 3 people on this page 7 years ago to the mid-20s we have today. And the exciting news we wanted to share is that Chow Ma, who's a very senior portfolio manager at Coopers and, roughly 17 years experience in the industry, has effectively, we've been able to bring her across to Munro Partners. She's joined Munro in the last month or so, and she's going to be helping us out with the global equity products that we run today. And that's really testament to our partnership structure. And she's going to add to the investment team. And on top of that, we have Jean Huang, who's also joined as an analyst, and that brings our investment team up to 11. And that's in line with, similar hires that we talked about over the time, being Mike Harut, who's come across from Axie and the Future Fund, and Hugh, who came across from UniSuper. And so we're just excited to be able to continue to build up this page and continue to build it out with, what we think are very talented people who are going to help us achieve our goals.
Okay, excellent, terrific. Well, with that, why don't we move on and talk a bit about the market and what's going on in your portfolio? And I think, as we all know, it was a tough year for investors in 2022 across multiple asset classes, no more so than for the cohort of growth equity investors. Can you touch on 2022 and provide your thoughts on how markets have started off in 2023?
Yeah, so most of the time we're going to be talking about the absolute return products here. And so I am going to, touch on the performance of our products last year and then talk about, how they're positioned. And most of the time we're going to be, as I said, talking about the absolute return product, because that's the one that most people are invested in. And that's where, some of these capital allocation decisions we've been talking about over the last 12 months become important. Just important to flag, we do have the other products and are happy to talk about them in the Q&A. And so as I said at the start, our goal is to be your global growth investor. And this is the nice tranquil picture that growth investors have had for basically the last 20 years. Effectively, we've lived in this very tranquil world where interest rates, what I'm showing you here is US 10-year bonds, have progressively gone down, and debt in the world has progressively gone up. And this lowering of rates over time has effectively raised multiples across the market, but also led to quite frankly a very tranquil economic environment to be a growth investor. This all changed obviously at the start of last year with this huge uptick in long-term rates, and obviously this situation that central banks got themselves into. Everyone's familiar with this now. I showed this chart. This is the same chart I showed actually in January last year. This is what they thought they were going to have to do rates. This is what they ended up. And Jerome and other central bankers around the world have been slowly pushing these rates higher all throughout last year. Why did this happen? Well, it's basically, in our opinion, it's effectively COVID's fault. We put way too much stimulus in the world during COVID. COVID went away very, very quickly over the summer last year, or over our Christmas last year, and it became very clear that central banks were behind the curve. Because of COVID, inflation got out of control. Central banks have had to raise rates, and we've been essentially dealing with this very difficult economic environment. We were very aware of this back in January, and anyone who's dialed into these calls knows that, you know, we instantly realized we had a problem about the second week in January and started to raise cash. We raised roughly 40% cash, and we spent most of last year, and if you look across the performance of the funds, we spent most of last year, you know, our single goal as a growth investor was, quite frankly, not to give back all of the gains that we'd had over that great period that I showed you earlier. And so we went very much into capital protection mode. We had to rely on our disciplines around stop losses. We had to rely on our disciplines in terms of raising cash. And ultimately, while some things went right and some things went wrong, you know, in the end, you know, we did manage to, we had drawdowns in all our funds, probably a little bit worse than we would have liked. But all of our funds were down sort of mid to high teens last year, and on a 12-month rolling basis, roughly 10%. That's frustrating, but ultimately not the car crash that I think it could have been. We're now at this point where we're trying to put that cash back to work. We're trying to get a bit more constructive, and so happy to go back to this in the Q&A, but maybe it's now time to talk about 2023. And obviously here we are off to a slow start also, and again, you know, that's fairly normal for us at this sort of time. You know, the pragmatism that we showed last year to basically avoid the mess that happened in growth equities is basically costing you a bit of relative performance right now. That's fairly normal. But as I look forward into 2023, you know, we showed you these three signposts that we've been working on all through last year. We basically said, you know, we've had this large disruption at interest rates, and that's ultimately going to be one of the issues that we have to deal with. And secondly, you're going to have an earnings disruption, and thirdly, you're going to have time. And so we've had this simple checklist about how we put capital back to work. And as we came into 2023, you know, ultimately we are more constructive markets in 2023. We were more constructive before the year began. Two of the three things we are looking for have actually been ticked off. And the first is that long-term interest rates have probably peaked. I know that there's a little bit of concerns at the moment with sticky inflation, etc. But I do think that while inflation will remain sticky, that the comp effect of inflation, as we cycle these big comps last year, means it naturally comes down. And long-term rates, while they are bouncing around a bit now, have probably peaked. So we're happy to give that one a tick. The second thing, you know, we always talked about a lot last year was time. You know, your standard bear market lasts anywhere between 12 to 18 months. You know, we're 15 months into this one. And the reason why the bear market can only last that long, because it only takes so long to price these dislocations. The reality is that even though the recession may start next week and run for a year, the equity market should, in theory, be able to price it within a much shorter time horizon. And so as we came into this year, Steve, the one thing we really were worried about was earnings. It was really the last shoe to drop. You know, how bad is the slowdown going to become from these huge rate hikes? And once that happens, we've effectively priced the economic dislocation that this rate experiment has had. And we can go back to doing what we always do, which is basically just picking stocks and finding companies that can grow their earnings and share price that can grow. And so the one thing that I would say is that obviously makes us a little bit more constructive since the start of the year is, you know, and this is what I'm sure, you know, you've probably been on a lot of webinars. They're all saying the same thing. You know, is it a hard or a soft landing, or is it no landing? In the end, we don't actually care that much. We just want this uncertainty to go away, and this is why we've probably been a bit more prudent, at least in the first couple of months of this year. And so, from our point of view, you know, there's two options here. This is inflation over the last 20 years. You're either going to have, as rates go up, inflation will come down. As rates go up, growth will come down, and you're going to have either a hard landing, which is the red line, which is what traditionally happens, i.e. rates go up, housing goes down, you end up with credit problems at both personal finance and mortgage finance. And, you know, some banks get themselves into trouble, or large property developers, et cetera, get themselves into trouble. That's your normal outcome from here. And still a lot of people are talking about that. And I'd want to be clear that that's still potentially on the table from here. The green outcome is the one where you find a way to get through this, and there's a bunch of offsetting indicators that are helping this happen. So that's sort of the reshoring of the US economy, or the reshoring of global supply chains, the money that we have to spend on the energy transition that you know is something we like here at Munro Partners. And that got a huge boost over the summer with the China reopening. So with China reopening, you effectively are more likely to head to the green line than the red line. And so from our point of view, this is a slide we built before Christmas to basically point about these options. We don't know which one of these options is going to play out. We should know within the next 3 months. But from our point of view, you know, we already had 2 of these things ticked off. It really was the third one. And the third one is looking a little bit better than it definitely did a couple of months ago. So from our point of view, constructive about 2023. And if anything, it's got more constructive a bit sooner than we otherwise would have thought.
Okay. So as you just said, you're not fully invested right now. Just if you can elaborate a bit further, what will you need to see before you feel like you can get the cash back to work, you know, and get your net exposure back into the 90s or even 100%?
Yeah, so from our point of view, as I said, you know, it was roughly 40 to 40% cash that we raised back in January. And I'll show you some of these slides later, we've sort of got that back sort of to 75% is our net exposure roughly today, or it will be at the end of February today. So we put about 10 to 15% of that cash back to work through January and February, specifically in areas where we can see growth starting to accelerate. And these are mainly semiconductors and emerging consumer, and I'll talk about that in a second. The thing that is holding us back, or the thing that's being a little bit prudent at this point of view, is one, most importantly, you don't actually know, and every webinar you've probably dialed into probably hasn't told you the answer. They told you the view, but you don't actually know which one of these outcomes you're actually going to get yet. We know there are delayed effective interest rates. We know that you know things are definitely slowing out there. And so from our point of view, we still don't think this is a done deal, that the red line's completely off the table. And so from that point of view, I think it pays to be prudent, at least in the short term. The second thing, just to flag really quickly, is the market is not pricing the red line at all. So effectively, this is what S&P earnings estimates are expected over the next 6 months. So clearly not a red line outcome. This is COVID. This is 2008. So no one's expecting the red line to occur, or no one's expecting a very large slowdown here. And secondly, this is S&P earnings over time. And so S&P earnings, in theory, normally, you know, should normalize back into this trend. There are a lot of companies out there that we know have been over earning in the last 12 months. It happened to tech 2 years ago. It's happened to airlines and hotels more recently. And so in theory, this number should come down. But most importantly, you know, in the end, if it comes down, the market will bottom well before the earnings bottom. The market will effectively look to the other side. But the last thing, I suppose, that is holding us back just a little bit at this stage, Steve, and suggesting to stay just a little bit prudent, is that the price is, it's not that the process that we're talking about isn't happening. The process we're talking about is happening. And we're excited it's happening because we just want to get it over and done with. What's interesting is the price is never really giving you an opportunity to buy the market. And so this is the PE multiple of the S&P over time. It's only really got down to 18 or 16 times. It's never really got back to the 14s and 15s that you would expect. And this is the equity risk premium. This is something we talk about a lot on these calls, you know, the earnings yield of the market minus the 10-year bond yield. And if anything, it's got more expensive. So normally you're buying the market when it gets to sort of 400 or even 600. Well, today we're at sort of 200. So there's 3 reasons I can give you as to why the price hasn't achieved what we and maybe some other people were hoping for. The first is one that we have a lot of sympathy with, which is the S&P 500 is not the economy. You know, it's full of great companies like NVIDIA and Tesla that are doing great things. And so the economy won't really affect them. And we have some sympathy with that. The second is that, you know, maybe there's masses of liquidity out there. There's just too much liquidity from COVID that's ultimately, you know, continuing to step into the market. And the third is that it just hasn't happened yet. And maybe you just need to be a little bit patient. And so from our point of view, we think it's a combination of all 3. And we think, you know, that we do have some cash on the sidelines, and we think if we're a little bit patient, we'll get an opportunity as the year goes on to slowly put that back to work and basically get back to 3 ticks and have a much more constructive outlook going forward from here.
Okay, good. Capital protection plays an important role within the fund, Nick. Our listeners are always keen to understand how you're protecting the portfolio today. Can you talk more about this?
Yeah, so from our point of view, capital protection is something we've talked about a lot, and it's probably, and you know, something that we're probably still going to need, at least in the short term, as we get through, you know, this last part of pricing in this economic disruption. From our point of view, as you know, we have the core bit of what we're going to do, and hopefully we're going to get some time to talk about today, which is picking great growth stocks, whether they're in AI or emerging consumer, etc. We have the ability to raise cash. We have the ability to short sell. We have the ability to buy put options, all revolving around our capital preservation mindset. From our point of view, this picture just shows what we added from capital protection in the last 12 months. And from our point of view, this is, a slightly disappointing outcome. We would have liked to have added more through the downturn of last year. But it's clearly, as you can see quite clearly, the downturn we dealt with last year was very, very different to, say, the COVID downturn where the market went straight down. We added roughly 6.7% here. We added 1.8% back here. We basically added about 1.6% over the last 12 months. And it really is these strong bear market rallies along the way where we've continued to buy protection to hedge against a potentially worse outcome. And importantly, as we've started 2023, obviously we are lagging a bit at the start of this year. One of the reasons why is because we are continuing to buy protection, potentially on these worse outcomes. And so we are overspending on downside protection at the moment. And we're doing that because it remains an uncertain economic time. But importantly, that will go away in the next 3 to 6 months. And that uncertainty will disappear, and we'll know whether this was, another one of these bear market rallies or it was actually the bottom of the market. This is, again, as I said, very normal. Same thing sort of happened back here. Same thing happened here. You just didn't see it because it happened so quickly. And so from our point of view, we think we'll continue to spend on capital protection. And yes, this outcome was not as good as we would have liked over the last 12 months. But moving on from that, the one thing that did obviously help us significantly in the last 12 months was our stop loss protocols. Our stop loss protocols were ultimately, the thing that makes us different from most other growth managers, where we basically do continually review our investment cases. We know that there's only going to be a few winners, and there's going to be lots of losers. I talk about this all the time. We as a team talk about this all the time. These are some of the stop losses companies that we actually managed to exit in January last year that fell significantly. These are the ones from the year before. And so, our ability to stop ourselves out of particularly the high multiple tech stocks, be it in 2021 and the start of 2022, is ultimately, led to this smoother outcome versus our peers. And this process has actually stood up very well through the last 12 months, and ultimately supports both our long short fund and our long only funds. And then this last thing, just in terms of capital protection, look, as I said, this just shows you the net and gross exposure over time. As we dropped exposure here, as I talked about in January, you've effectively seen these false starts that we've seen a couple of times. Many times this is coming up mainly because we're just covering some of the shorts. We are in this difficult process of effectively getting the capital back to work. It is always difficult this time. If we have made a false start, ultimately you can be confident that that the protections are under the surface there, and we will move back the other way if we have to. But in the long run, as I said at the start, from our point of view, we feel this is a process. It's a process that started January last year. There is one last piece of the process we're still worried about. If the market gave us the right price, we wouldn't even worry about that. And so from our point of view, our goal, as you said, Steve, is to get this back up to here, because stocks are going to follow earnings in the long run, and this, like every other dislocation we've been through, will pass. And the good news is it's closer to passing. With each earnings downgrade, we are getting closer to passing than this economic dislocation being priced in, and stocks will effectively go back to following earnings. And all you're seeing here at this last bit is basically the pragmatism we had to use to get through here is effectively costing us a bit here. Again, that's fairly normal if you go back over our track record over the last 15 years.
Okay, thank you. So why don't we move on now to your key areas of interest in the portfolio. Over the summer break, we were all introduced to ChatGPT, and we're now starting to read about and slowly understand the power of what AI could bring to the world. I'm keen to hear your view, and I'm sure people on the call are keen to hear your view on this.
Yeah, thanks, Steve. So this is the the fun stuff, and so this is the good news that we've seen over the last 3 months. So this basically is a snapshot of the fund here at the end of February. These are the areas where we see strong structural growth in the years ahead. And that structural growth, roughly the weights, be it climate, be it high performance computing, be it emerging consumer, be it innovative health. These are a number of holdings, and these are some investments. I did say we had put cash back to work in the January-February period. A good chunk of it went to these two middle ones. And there's a reason why I'm going to talk about that today. And so you mentioned ChatGPT. Look, what's interesting about this is, anybody who has heard us talk about high performance compute knows that, we have a long-term structural, we see long-term structural growth in high performance semiconductors. We do. Why do we? Because semiconductors go through these wonderful periods. So this is semiconductors in 1997. We used to sell 1977. We used to sell none. Last year we sold 500 billion semiconductors, and we think you're going to send 1 trillion. Semiconductor demand has been through, 4 fairly simple cycles, be it a mainframe. As semiconductors get smaller and faster, you can do more things. So you go through a personal compute period. As semiconductors get smaller and faster, you can do more things. You go through a mobility period. As they get smaller and faster, we're moving into the AI period. And the AI period has always been there. It's going to get super exciting. It's just that ChatGPT basically made you think about it. And so from our point of view, it's important to stress, AI has actually been around for a while. It drives recommendation engines like you see on Amazon or Netflix. It helps drives your parking assistant on your car. I think the good news about ChatGPT is it ultimately, was a bit of a gimmick when it first came out and everyone liked it. But what it's done is it's allowed the market to focus on, geez, next quarter's earnings are going to be bad, to, wow, look at what the long-term opportunity is here. Look at the long-term earnings growth that these companies are going to give you. And I think it really took a next level up when Microsoft's effectively launched the new Bing. They're going to integrate it with ChatGPT, which is ultimately forcing Google to launch their own AI products. And so you're just going to hear about AI. And unlike the metaverse or blockchain before it, this stuff's pretty real. People on this call will already be using these products. And it's probably going to touch every part of the industries that we look at today. And so interesting examples we see out there are things like software development, whereby, Microsoft has integrated it with GitHub. And that ultimately allows GitHub, to predict the programming that you want. It makes programmers up to 80% faster. We talked about marketing. What people probably don't know is your Moderna vaccine effectively came from AI. They managed to develop it in 5 days because they can identify the proteins and et cetera and what they're trying to do. You're going to see it in financial services and law. So this will touch every part of the world very, very quickly from here, because these two big internet companies have put this on the table. Maybe just a quick diversion, Steve, and I know we're trying to do this quickly, but it's important that people understand how these things work. They're actually just effectively predictive text on steroids. All these things are doing is they're large language models that are effectively predicting the next word that you want to hear. No different to on your Gmail, but just on a much, much bigger scale. They're doing this by effectively training these things across parameters. And so this is just a good slide showing you some of the bigger large language models in the world today. And this just shows you the logarithmic growth of the parameters of those models. And so from our point of view, if you look at the GPTs here, GPT-2 was out here. It had roughly 1.5 billion parameters in it. GPT-3 was actually developed in June 2020 and has 175 billion parameters in it. And then they've effectively been training it for 2 years, and now they're showing it to you. GPT-4, that's apparently going to come out this year, has nearly 1 trillion parameters in it. And so what these things are doing is just billions and billions of calculations to ultimately predict what you want to hear. And so how do you invest in this? How do you make money out of this? It's really simple. It's semiconductors. Semiconductors are basically, you just need thousands and thousands of compute to drive these things. There's a joke out there that it's not actually artificial intelligence, it's artificial stupidity. You basically just need to throw millions of billions of binary outcomes to get these things to work. How they're doing it is using a CPU, which is something that's in your laptop. That drives your computer, which ultimately can only do 4 or 5 things at once, and combining it with GPUs, which are graphics processing units that have thousands and thousands of cores. You put these together in what's called accelerated computing. Here's Jensen Huang with one today. Put these in server racks, put them all in a big server, build as many servers as you can, and process as many of these issues as you can, many of these iterations as you can. Just so you know, your standard ChatGPT query costs roughly 10 times what a search query costs. So the faster these products get rolled out, the more compute power we're going to have to put in. And so from our point of view, we see some pretty big winners here. And we have seen it before. People have heard me talk about this before. We just had this little cyclical bump. I'll show you back here, this little cyclical bump that meant everyone forgot about it. They forgot about it, but it's still going to happen. And so from our point of view, your big winners are the people who make CPUs and GPUs, of which there are 3 in the world today, NVIDIA, AMD, and Intel. NVIDIA is by far and away the leader. The foundries that help these guys make the semiconductors is important. They don't actually make them, they just design them. The foundries that make these, the biggest one is clearly TSMC. TSMC has 80% of the demand for high-performance computers. And lastly, ASML is the company that helps this shrink happen. So we are specifically just talking about the bleeding edge or the leading edge of semiconductor demand, because that's ultimately going to drive what these products do. These people desperately want this technology. They have to drive up to these 3 companies to get it. This is what should happen to their growth. This is your server demand. This is your high and no demand for TSMC, and this is your EUV demand. And so regular semiconductors are down the bottom here, not growing, but the bleeding edge is in structural growth. Why? Because every single company in the world is going to need this technology to beat their competitor, and it's all going to force down to these few companies. So these are the big investments we like here. Cyclically, they had difficulties last year. We've always liked them. We've put a lot of capital back to work on them in the last 3 months. And that's really one of the exciting things that I think happened over the summer. That again, as I said, makes us feel just that little bit more constructive medium term, because the market's finally given up looking at whatever next quarter's earnings are going to do and started thinking about what's really happening in the world, which is where the strong growth is going to be.
Okay, and what about other themes, Nick, in your portfolio? What are you adding to right now, and why do you think they will work over the next few years as well?
Yeah, so the other one that obviously happened over the summer was emerging consumer, and so I'm sure it'll come up in the Q&A, but China reopened very quickly. That was always potentially going to happen. Look, from our point of view, does that mean you go and invest in China straight away? That's a bigger question mark. We're not forgetting the problems that have happened there in the last 24 months. But what we do know that is if they let Chinese people get on an airplane and they travel, then they're going to travel. This is the whole reopening tailwind that we just had. And that's going to be great for luxury good companies. It's going to be great for travel companies. And so from our point of view, we already own these companies in the fund, but again, this is where we've put capital to work, both pre and post Christmas. This is just showing you Louis Vuitton structural growth from 10 billion to 30 billion, or Cartier, which is enrichment from 4 billion to 8 billion in their products. And so the simple way to think about this is, again, a simple area where you can just look over the valley. You don't need to think about next quarter's earnings because the growth is coming. This just shows you, pre-COVID, how much sales were coming from Chinese consumers. It's roughly 30%. It's 21% in 2022. Just to get back to where you were before, you're getting a 7% upgrade. And we'd argue it gets much better than that. It's the same over here for Richmond as well. And so from our point of view, again, this is constructive signs because, again, all we care about is companies just going back to following their earnings, not getting pushed around by interest rates and not getting pushed around by short-term macro concerns. And the reality is these companies also, have moved to new all-time highs. And that's a very positive sign. It's good news. And in many cases, we've owned them the whole way, but we have definitely put more capital to work on them in the last couple of months. And the reason why they're doing it, and the same reason why we're doing this with semiconductor demand, is because you can see the other side of the valley. You can see the other side of the macro slowdown. And so these are two obvious places to put some of that capital back to work, mainly because of the changes we saw over the last 3 months.
Okay, and what about some other ideas that the team are working on? And I guess what's stopping you from investing in those ideas today?
Yeah, thanks, Steve. So the one thing, that I'm sure is going to come up in the Q&A and something I showed a lot last year is this is the revenue growth. This is your standard equation for a growth investor. This is revenue growth and this is free cash flow yield. The faster growing company you buy, the higher multiple you have to pay for it. As I talked about earlier, the stocks in grey are all stocks we had to sell at the end of 2021 and the start of 2022 because, Jerome was going from here to here. From our point of view, those companies we still like, and many of those we have not yet reinvested in. So we're still very happy with big cap technology. Be it your Microsofts, your Googles, your Visas of the world. We know some of them are having difficulties, like Amazon, for instance. But we feel very confident that they're going to find their way through that. They are the big winners in this AI generation, this AI shift. And we, again, think people are getting very short-term focused on these companies and forgetting about the longer term. And so for those big cap winners, we're still very happy with them. To answer your question, Steve, the thing we're working on is which of this whole bunch of growth stocks that got thrown out last year, or particularly in technology or high multiple technology, we should be reinvesting in. And so from our point of view, we know that these stocks have had a good start to the year. Part of that's mainly because they had a terrible end to last year on tax loss selling. We do think you'll get multiple chances here. If you believe in the green line I showed you earlier, then rates aren't actually going to come down that much this year. These stocks are still expensive and still slowing. But there are a handful of them that we really like on any sort of medium-term view. And you can be assured that we will be going back to those companies when we feel the timing is right. But they unfortunately still fit in that category where the price is probably either they've gone a bit early in our point of view or the price is still not quite right. And what we're looking for is that acceleration in earnings growth. And we don't see that just yet. We do see that in these other areas. Like I showed you earlier, like high performance compute and emerging consumer. We also see it in climate that we haven't talked about it today, but as I've always said, earnings growth drives stock prices, and we want these companies to start accelerating again before we're prepared to commit capital to them today.
Okay. Look, and this is the last question from me, and then we'll go to the audience Q&A. So we're getting clients asking the question, do growth stocks still work in a 5% interest rate environment? What are your thoughts on that?
Yeah, it's a good question. So from our point of view, I think the thing, and what I've tried to explain through this webinar, and I've tried to explain a lot over the last 12 months, it's not actually the absolute level of interest rates that's the problem. It's the movement in interest rates that's the problem. So if I go, it's the 0 to 5% that causes all the deratings. And then it's the 0 to 5% that in theory is going to cause some earnings slowdown. And then once those two things are out of the way, then stocks are just going to go back to following earnings. And that's what I think is why we're feeling that little bit more constructive, is because we're starting to see this happen already. From our point of view, if I go back over the 16-year track record we have of double-digit returns, so that's nearly 7 years at Munro and 10 years at our previous firm, that's actually happened at 6% interest rates environments. It's happened at 8% interest rates environments. The dot-com boom inflated in a 6% interest rate environment. So from our point of view, the actual level of rates is not that important. It's more the delta of rates and the effect that that's had. And as I said at the start, we feel we are coming to near the end of that. The only thing that doesn't quite add up right now is the price. And we suspect we will get that opportunity in the months and weeks ahead. The last thing I would say, Steve, though, is, and I think this is important, it's something, sorry, I neglected to say earlier. We have come into this year with a more diversified portfolio. So from our point of view, if I showed you these areas of interest 2 years ago in the middle of COVID, it was effectively tech and lots of other different derivations of tech. We don't think in a 5% rate world, or if you believe the green line, that you want a portfolio of all tech going forward. We think you need a diversified approach to growth investing. And so that's why climate's our biggest area. Semiconductors are tech, but they're not high multiple tech. Emerging consumer is retail, healthcare, and we do own tech within, as I said, digital payments and internet, but mainly the big ones. We do think you can reinvest into tech, but it's important to stress, if I look at that 16-year track record, it wasn't all made by just buying high multiple tech stocks. It was made, with energy, it was made with retailers, it's been made with climate, it's been made with semiconductors. And so from that point of view, we do think a 5% world, you should have a more diversified growth portfolio. And secondly, you probably want a slightly lower multiple portfolio because you are comparing back to that risk-free rate, whereas previously the risk-free rate was not there at all. And I think that's sort of what's holding us back, as I said, from these really high multiple companies that I know are off to a good start this year. But I do think you will get other opportunities.
Okay, great. Well, let's go to the audience Q&A. And the first question I've got for you is a market question. Do you see the potential for the market PE multiple to expand even while earnings are being revised lower, meaning share prices hold up okay despite EPS being revised lower?
Yep, it's a good question, and clearly that's what's happening already. And so let me be clear about this. The fact that the price hasn't got to the level that you thought it should is something that people are very hung up on the moment, and clearly we were a bit hung up on it as well. But if earnings do bottom, as the question's saying, or if earnings do come down far enough and the price doesn't give you that opportunity, then you're just going to have to move on. You know, multiples are effectively a bit of a dark art to a certain extent. Predicting the earnings of a company is quite simple when we do a lot of work to do it, and we speak to the companies to try and work out how their business is going. The multiple it should trade on is a slightly different story. And to the person who's asked the question's point, yeah, if earnings keep coming down here and the recession, you know, in theory starts or doesn't start and earnings start to bottom out, then the market's just going to move on. And if the bottom of the multiple is 16 times instead of 14 like you thought it should have been, then you're just going to have to deal with that. And so from our point of view, that is what's happening at the moment. It's definitely a little bit perplexing, but in the same breath, you know, the green line has got a lot more support than the red line so far this year, you know, and we haven't seen any big credit blow-ups yet. And so from that point of view, that could happen. It is what's happening at the moment. And if it does happen and earnings bottle out, and as I said, we are being a bit prudent here, but I think it's going to pay to be prudent, then we're going to move on as well.
Okay. Stock question for you. The Grand Prix is here in Melbourne in about a month's time. You've talked about the stock before. Would you look to buy it at some point?
The Grand Prix is in Formula One.
Formula One, yeah.
Yeah, okay, so I don't know. We did buy the stock a couple of months, well, basically back in mid last year. So the questions around Formula One, I don't have the slide for it at the moment. So the questions around a company called Formula One. Formula One is a tracking stock or a holding company for the business of Formula One. So excitingly, you know, you can't own many sports in the world. We worked out there's actually only 2 listed sports in the world. One's Formula One and the other one's wrestling. And please don't send me hate mail about saying wrestling's a sport. And so from our point of view, yeah, we really like this business. It's one that we liked for years. And the guy who's asked the question is right. Yeah, we have looked at it for a long time, and it's one of the companies we got the opportunity to buy last year, and we have bought it. It's roughly a 3% position in the fund. We'd like to make it bigger. There's still a couple of things we're working on. But yeah, that's the great thing about bear markets is they do give you these opportunities to buy some things you might have missed the first time. And that's one we missed the first time, and it's one that we have invested in. And we think there's a lot of opportunities for them to improve the profitability of that sport. And the simple ways to think about this are, you know, their ESPN contract in the United States is only $80 million per annum. The NFL's $15 billion. And so from that point of view, you know, there's quite a big gap there. Just by making Americans more interested in Formula One. That's why they're putting American teams into Formula One. National advertising, you know, there isn't a national. Amazon Web Services is now the cloud provider for Formula One. They didn't have that before. So there's some really simple things they can do on top of obviously what they're doing with Drive to Survive. And yeah, we think it's a great investment. Others might have found it a bit before us, but we're very happy to now be on board.
Okay. And what about short opportunities at the moment? Can you talk about those? Yeah,
thank you. So shorting, as you can see from this picture, was very problematic last year. You had these huge rallies, and we may be in the midst of one right now. But these huge rallies that we had basically in July and March made shorting very, very difficult. What we have learnt in the last, in the last 12 months is to be much more nimble with our shorts. And, you know, we obviously did very well in the September quarter on shorts and then had to move very quickly in October when the market rallied. And you can see at the moment we are being nimble again right now. From our point of view, the shorts in this market are pretty obvious. They are any company, you know, and maybe I'll just step back a bit and to getting right back to the start of this thing. It's important to understand as to how big a mess we've made of the planet on the back of, you know, some of the things that we did around COVID or some of the stimulus that we did. We were just on the phone to Amazon actually just before I got on this call. And Amazon's obviously having a tough time, but they sort of said, look, if the pandemic had just been and gone, it would have been fine. But the pandemic went and gone, and then we had fuel price, then we had labor price, then we had inflation, then we had supply chain problems. And they've just been dealing with this horrible environment for basically 18 months, and their retail business has lost money for 18 months. Amazon's not alone here, so the shorts that we like, any company that has a low margin that's ultimately going to have to drop their prices. And so from our point of view, business like Walmart, for instance, is one we're short at the moment, where their wage prices are going up. Their revenues are probably going to go down as inflation goes down, because they're going to have to, all the price rises they took, they're going to have to give back. Yet their labor costs are going up. And unlike Amazon, their margins are only 2.5%. Freight would be another area in that we've looked at, and potentially industrials. And so from our point of view, we have some good short ideas out there. We have a handful of them on at the moment. We would happily put them on once we got confidence that the earnings downgrades were going to come, and in theory, those earnings downgrades, are going to come in the months and weeks ahead.
Okay, and a question for you on NVIDIA, just on the recent earnings result. Have you got any comments you'd make about that?
Yeah, so from our point of view, so NVIDIA, we talked about this. For those of you who don't know NVIDIA, stock I've obviously been pretty vocal about. It's founded by Jensen Huang, who is in theory they're going to look back, I think, in 10 years as the founder of AI. And I think the really good thing about the result for NVIDIA, and I'm not sure if I've got a chart here. No, I don't, is NVIDIA was one of these companies that basically had to deal with downgrades last year. So this sort of downtick in the inventory around its gaming chips in particular, and also in inventory around data center chips, saw its earnings go down last year when we thought they were going to go up. Why? Because the macro got very difficult on them. In the result, I think Jensen made some pretty amazing comments where he basically said, our outlook for 2023 has changed dramatically just in the last 60 days. And he said, basically called ChatGPT the iPhone moment for AI. And he said that every company in the world, because Microsoft's now put this on the table, every company's now scrambling to catch up. And the inbound demand for their products is through the roof. And so from that point of view, he said that he felt that was the low point of earnings, and that earnings should go back to growth. And on top of that, he said, he talked about, the potential opportunity. And so this is what I'm talking about, the market being able to look through the valley of these earnings downgrades to the other side. And obviously this has happened with NVIDIA, and Jensen confirmed that on the call. And now we're basically just trying to work out how big the TAM is and what their earnings could be in 2025 or 2030, which is basically back to what, we always do. And from that point of view, we think the earnings could be anywhere between 5 and 10 times bigger over the next 5 to 10 years. If you just think about the total addressable market of accelerators and the fact that, NVIDIA is taking the largest chunk of this growth, and the fact that NVIDIA is, roughly 65 to 70% of all the demand. And so from our point of view, this is where we think the earnings will go, and the share price will follow its earnings. The only problem with NVIDIA is a bit like the whole market, the price has not really got low enough to be really comfortable with the risk reward. So we have a position there, but it's definitely not as big as we'd like it to be.
Okay, and we're getting a couple of questions, Nick, on Tesla. Do you want to just talk about Tesla, your view on that right now, and how you're handling that?
I've had some pictures at the back here, I think. You can help with Tesla. Okay, so Tesla has its Capital Markets Day tonight, for those who are not watching. Tesla's, again, one of these companies that gave you a good opportunity last year to buy some, and we have bought a little bit. Again, these things move quickly, not as much as we would have liked. And if we got another opportunity down at the price we're happy with, then we'd potentially buy some more. Why do we like, and the reason why I keep talking about price is because price basically makes up your risk reward to get that double-digit return outcome you're looking for. And if you bought Tesla at any price last year, that didn't work out so well for you. And so from our point of view, it did give you that opportunity over December. We bought a little bit. We'd love to get another one. From why do we like it? Because electric cars are accelerating. This just shows you China. This just shows you Europe. This just shows you the US. The US is going to inflect dramatically. So this percentage of electric cars being sold as battery electric vehicles, this one's going to inflect very quickly because they're paying you effectively a $7,500 subsidy as part of the Inflation Reduction Act to buy a car in the US, and Tesla's going to sit very much within that. Tesla's nearly 40% of all electric cars. In fact, I think it's more than 40% of all electric cars sold in the United States today. And then when Tesla gets down to a price where you're only having to pay 25 times for it, as much as you may like or not like Elon, you know, that's a pretty good opportunity. And so from our point of view, we'll be really interested to hear what they have to say tonight. And this is actually our whole list of beneficiaries from electric cars. And so importantly to flag that it's not just Tesla, you know, our bigger positions actually in Samsung SDI, which is a battery producer that supplies BMW and Rivian. We also have positions, as I've talked about in the past, in the semiconductor supply chain. And we are definitely looking at some of these other companies that are all actually in our climate fund today, but haven't graduated to the main fund just yet. And all of this is basically, as I flagged earlier, as part of our climate area of interest, which we didn't talk about today. But we still, you know, but despite the fact it is off to a slow start this year versus, say, high multiple tech, we still feel that, you know, ultimately this is the best area for earnings growth in 2023, because the earnings growth is entirely being driven by this huge government subsidies and this huge momentum that is occurring. And we feel more confident that you're going to get earnings upgrades than you will here, than you will say in you know, your fifth line software provider.
Okay, look, I'm conscious of time, Nick. We've gone through 45 minutes, so maybe we wrap it up there. But just before we do conclude, is there anything you'd like to, any final comments from you?
Yeah, so from my point of view, maybe I'll just quickly reflect on a couple of things I've just said. Look, I recognise last 12 months is clearly not a perfect picture from our products. And ultimately, you know, this is a growth manager, which basically is trying to get through this macro dislocation. This macro dislocation started in January last year, and it's going to end sometime in 2023, or at least be fully priced in 2023. What we are encouraged about is that stocks go back to following earnings. We are already seeing this with companies like NVIDIA and semiconductors. We are already seeing this with, I said, luxury goods, where you can look to the other side of what the potential slowdown is going to happen. And as the years goes on, more and more of this is going to happen. And so from that point of view, medium term, we are constructive. Last thing I'd say, just recognize, obviously, last few months, a bit frustrating in terms of not getting all the capital back to work. And here we are literally just being a little bit prudent. This is, again, perfectly normal for us. I can assure you that, you know, if I go back to this slide, this actually happened to us before, back in 2018, where we were a bit slow to get the capital back to work because we wanted to make sure the coast was clear. This is exactly what we're doing here today as well. From that point of view, it's important to flag, we did go on to make 50% the next 2 years. I can assure you all my money's in this fund as well. And from that point of view, you know, we're very keen to continue to build on this 10% double-digit return track record over the cycle. And I do think we are quite well set up to do it. Lastly, I just say, look, I understand it's a frustrating time. Please do use our materials to talk about this, because as we said right from the start, it's about investing in the journey. The journey will continue. We've talked about a lot of the good areas where it's going to continue, and we personally are pretty excited about how this is all going to play out in the months and years ahead.
Okay, well, terrific. Well, Nick, thanks very much for the update. It's much appreciated. And ladies and gentlemen, thank you for dialing in today, and especially for your ongoing support. We really do appreciate it. As a reminder, Munro offer 3 funds. They have the fund that we spoke about today, the Absolute Return Munro Global Growth Fund, the Munro Concentrated Long Only Fund, and also Munro's Climate Change Leaders Fund. All 3 funds are offered via platforms, and you can also access these funds via the ASX. Our next presentation will be on Munro's Climate Change Leaders Fund, and we hope you'll be able to join that call also. That'll be early in the second quarter. Now, we're going to provide you all with a copy of the presentation today, and should you have any questions, please don't hesitate to contact your GSFM account manager. Once again, on behalf of GSFM and Munro Partners, thanks for taking the time to join us today, and we look forward to seeing you all again very soon. Thank you.